Now, there are other issues that we might want to consider. Now, when we are trying to evaluate the performance of an entity, we might also need to look at all this, which the financials will not show. Now, how technologically advanced is the entity? If it is not using the latest equipment and processes, then it risks being pushed out of the market at some point, or having to undertake high level of capital expenditure. We might need to note this. Another thing is, what are its environmental policies? Is it in danger of having to pay for cleanup? If the law is tightened, does it appeal to those seeking ethical investment? Because obviously, from experience, some investors need you to have some culture before they can invest in your entity. So, what is the reputation of its management? If it has attracted good people and kept them, that is the positive indicator. We need to look at that. And what is the mission statement? To what degree does it appear to be fulfilling it? It should be good to have a look at that as well. And what is the reputation as an employer? Do people want to work for this company? And what are its labor relations like? It's important to look at this as well. And what is the size of its market? Does it trade in just one or two countries or worldwide? So you might need to consider this. And how strong is its competition? Is it in danger of being taken over? Now, let's look at this question as a way to evaluate what we've been saying so far. Now, we're given this question to deal with, and we have to do justice to it. We're told Yogi is a public company, and extracts from its most recent financial statement are provided below. We're given the statement of profit or loss for the year ended 31st March. For both 2005 and 2004, revenue and cost information were given to us. Statement of financial position were given. Now, in the note, we were told that on 1st April 2004, Yogi sold the net assets, including goodwill, of a separately operated division of its business for $8 million cash, on which it made a profit of $1 million. This transaction required shareholders' approval. In order to secure this, management of Yogi offers shareholder a dividend of 40 cents for each share in issue out of the proceeds of the sale. The trading result of the division, which are included in the statement of profit or loss for the year ended at 1st March 2004, are above awards are given. Okay. Now, note 2. The following selected ratio for Yogi have been calculated for the year ended at 1st March 2004. Require calculate the equivalent ratio for Yogi. 1. For the year ended at 1st March 2004, after excluding the contribution made by the division that has been sold. And 2. For the year ended at 1st March 2004, excluding the profit on the sales of the division. And B. Comment on the comparative financial performance and position of Yogi for the year ended at 1st March 2005. Right? So we'll look at this. Now, the first thing we are asked to do is to calculate for the year ended. You should calculate equivalent ratio, which is the ratio that has been given here. Number 1 is gross profit margin. Number 2 is operating profit margin. Number 3 is return on capital employed. And number 4 is net asset turnover. So, to start with, we have Yogi calculation of equivalent ratios, starting with the gross profit margin. We have 2004, 2005, we have 2004, right? We have 204, we have 204, we have 205. Now 204 excluding division that has been sold, right? Now to compute gross profit margin, we need gross profit, right? So gross profit for 2005 is 12,000. For 2004 is 20,000. Now for 2004, gross profit margin will be 20 divided by 50. For 2005, it will be 12 divided by 36. So we come here and say that in 2004 we have 20,000 divided by 50k. In 2005 we have 12 divided by 36. Now for 2004 excluding the division, the 2004, the performance of the division is revenue 18, gross profit 8. So we remove 8 of gross profit from this, we have 12, and we remove revenue of 18 from here, we have 32, right? So here we have 40%. Excluding that performance, we have 33.33%. No, 12 divided by 32, that's 37.5%. 37.5. So here we have 37.5%, and here we have 33.33%. Now the next ratio we are expected to compute is operating profit margin. In the operating profit margin, profit turnover remain the same, profit changes. We have 50, we have 32, we have 36. But how much is the net profit in each case? Let's come back here. So for operating profit margin, we have our profit before tax to be 411,000. Operating profit is before we talk about the finance costs. So we add back finance cost here, we have 47. And we had here we have 11.8. So we come here and say 11.8. 11.8 in 2004. We come here and say 11.8. Now here we have 47, but don't forget that we've been told that the profit made on disposal of the division is added. So here we change this to 37 minus 1,000 there. Now the profit here, you need to remove the profit from the this profit here of 5.8. You need to remove it when we are doing this excluding. Don't forget this is 2004 excluding the division. So we are 11,858. So we have 6,000. So we have 11,800 divided by 50,000. That's 23.6%. Then we have 6 divided by 32. That's 18.75%. And we have 37 divided by 36,000. We have 10.28 in percentage. The next ratio they want us to compute is return on capital employed. And the return on capital employed has been defined for us as profit before interest and tax divided by total assets less current liabilities. So we'll follow that definition. So we have ROCE. Now here, what we have actually used here is profit before interest and tax. So we have 11,800, right? We have 6,000 and we have 37. Now the denominator is what we need to compute. Denominator now for 2005 is defined as total asset less current liability. That's it. The capital employed. Total assets less current liability. Now the total asset for 2005 is 22,500. Then 29 in 2004. We have 22,500, 29, 200. We have 29, 200 minus current liability. Current liability will be 55 and 7,002. We have 72 minus 55. Now for the 2004, excluding the division that was being sold, then we have on that one we have what we have here, which is 29. We have 29.2 minus 7 will be 22,000. Apart from that, you then deduct what's the total assets. The value of the company sold for 8 million and profit of 1 million made, so the value of the company will be 7 million minus 7. So here we have 11,800 divided by 22,000. Here we have 6,000 divided by 15,000. And here we have 37 divided by 17,000. So what do we have at the end of the day? We have 11,800 divided by 22,000. Really? We have 53.6%. 53.6%. Here we have 6 divided by 15. We have 40%. And here we have 37. 37 divided by 37 divided by 170. We have 21.76. 21.76%. Now, having said that, the next thing is to talk about net asset turnover. Now we know what the asset is, then the turnover is what we then need to get. We have net asset turnover. So, which is turnover divided by assets. We have 22, 15, 17. 22, 15, and 17,000. Right? Now, having said that, the turnover in 2004 is given to us as now we can use the turnover we've used before as well. Don't need to start searching for it again. The turnover we have always used is 50, 32, and 36. 50,000, 32,000, and 36,000. So we have 50 divided by 22. That gives us 2.27 times 2.27 times 32 divided by 15. That's 2.13 times, and 36 divided by 17. 2.12. Okay, those are the ratios they want us to compute. The second part of the question, okay, that first part has the answer 1 and 2. The second part of the question is comment on the comparative financial performance and position of Yogi for the year ended 31st March 2005. To do this, we have to use the ratio we have computed. And what is the ratio telling us? A lot of story, right? Now, looking at the financial performance of this business, this is 2004 after excluding the division, and 2005 when the division is normal. So it won't make any sense to be comparing 2004 that has the division, a particular division, and 2005 where that division has been sold. No, the best thing is to look at 2004 without the division and 2005 without the division. Now, looking at it, our turnover has increased from 32 to 36, which is good. But our gross profit margin has dropped from 37.5 to 33.33. Meaning that one of the most profitable products that we have, or division, is the division that is being sold today. Now, looking at the operating profit margin as well, our profit margin has declined from 10.75 to 10.28, meaning that we've actually, apart from the fact that there's a decline in gross profit, meaning the division that is being sold is more profitable than other division, we can also see that the operating expenses has not significantly reduced despite the fact that the division has stopped, meaning that there are some fixed costs for that division that still remain within the system. Now, another thing is, if we look at it from return on capital employed perspective, number one is this return on capital employed will definitely not be good, because obviously profitability wise is relatively bad. Now, our ROCE is 40%, now declined to 21.76, almost half of it gone. So, meaning that the asset we have sold is one of the assets that generates significant sales. For example, if you look at the information we have, for instance, the turnover for the entity we've sold is 18 million. Let me do that small calculation here. 18 divided by the asset is 7. So 18 divided by 7 will give us 2.57 times, which is higher than any other thing we've computed. 2.27, 2.13. So meaning that the division we've stopped is not only that it is more profitable, it equally generated more sales in relation to its assets than other division. That has to be said as well.